Welcome to this Bennett Explains finance video. This week, liquidity, an absolutely vital word. There are not many words that investors must understand, but this is definitely one of them. So I'm going to split it into two parts because it's so important. We're going to deal with both aspects of liquidity, and this week I'll do the first one. So, investing's key risks are, and where does liquidity fit in? Well, price risk. That's not what I'm talking about this week. Investments go down as well as up, and sometimes over the short term, they can go down as well as up by a lot, and we capture that in volatility measures, and I've done videos on those, covering things like beta, the VIX, standard deviation, and so on. What I'm focusing on is this one here, because people often think, well, that's all I need to worry about, and actually it isn't. Liquidity risk comes in two guises. I will deal with both, hence part one and part two of these videos. Solvent people and firms can still go bust. That's the shock you get when you invest in a company thinking it's making profits and then suddenly bang, it's gone. And number two, some investments are easier to sell than others, and people often only worry about liquidity when it's too late to do anything about it. Just mention, not going to cover it here, there is a third risk, counterparty risk, and this can be a hidden risk. You need to ask about this, dig around, find out about it. This is the idea that the repayment of your money might depend on somebody else, a third party or counterparty. And going back a few years, people that had a kind of almost hidden counterparty of Lehman Brothers, for example, discovered the hard way that counterparty risk matters. So as an investor, you need to be on top of all three. I'm going to focus on liquidity risk, often underestimated in terms of its importance until it's too late. So let's look at two types of liquidity risk and focus on one here. So the cash flow version, I've called it, use rugby balls shapes for obvious reasons I suppose, is the ability to pay obligations as they fall due. That's one definition of liquidity. Can you meet your obligations to pay other people as they fall due? And you look at it from your point of view, you look at it from an investment, a company point of view. And then there's the investing version, which is I'm happy that the companies that I'm investing in can pay their debts as they fall due, so they're liquid. But is the investment itself, the shares I'm buying or the bonds I'm buying, for example, something I could sell quickly and expect to get my money back if I needed to do so? Now, I don't recommend panic or forced selling as it's called, but you need to be aware of the liquidity risk of the stuff you're invested in case you hit the point where you need to start thinking about liquidating, pulling money out or trimming and so on. So, going to leave part two to another video. Let's focus on part one here. All right, and as I mentioned, people often only look at liquidity once it's too late to do anything about it. So, the cash flow version, two types. As an individual, you can hit a cash flow crisis. All right, things happen which require big dollops of money in the short term, and I cover this in more detail in my financial fitness guides and so on, so I'll keep it briefly here. But leaky roofs, redundancy, illness are all things you need to keep a cash reserve for. Now companies, let's look at the investment side. Companies can suddenly go bust. They look profitable, but that's because they haven't sorted out paying debts as they fall due. It's not as exciting as profitable opportunities, it's not as interesting as growing sales, but it's a vital part of running a business. Now I want to say a little bit more about that in this video. It's a vital thing to look at before you make an investment. Now, solvency and liquidity are not the same thing, and people often make this mistake. They think, if I'm solvent, I'm also liquid. If a company's solvent, it's also liquid, and actually solvent people and firms go bust. Give me an example. All right, supposing I think, crikey, I've got to pay back a debt right now. I reach in my pocket, there's no money in there. What am I going to do? Okay, maybe I arrange an incredibly expensive short-term overdraft, but maybe I'm up against my overdraft limit. The bank won't let me have any more credit. So I'm thinking, crikey, I've got to pay this debt back. What do I do? I know, got a decent watch on. Walk into a pawnbroker, all right, and the pawnbroker looks at me and says, okay, Tim, I'll give you 30% of the face value of that watch for immediate cash. I am solvent, I have an asset, a watch that's valuable, but in order to get the cash that I need immediately to pay a debt back, I'm going to have to liquidate my best asset, the one I'm carrying on my wrist, let's say, at a fraction of its current market value. And that's the danger, is that you can be solvent, you can have assets, but when it comes to a crunch, you may have to sell them at a price that's way below what you should be able to recover for them in normal circumstances. And that's the key difference between solvency and liquidity, and it's important for companies too. Now, Solving short-term liquidity crises can be expensive if you can do it at all. For an individual, that short-term overdraft, ooh, that's going to hurt. That worst, that Wonga loan, that payday loan, those interest rates are going to be expensive. For a company, it can be expensive. And in a worst-case scenario, if you're up against your borrowing limits, it may not even be possible. Or you may have to sell, as I mentioned, assets in order to solve a short-term liquidity problem. So, solutions are going to be keep 3 to 6 months of capital safe and liquid as an individual. That's something we cover in other videos, in other guides. Here, just want to say a little bit about the sort of investing in companies side of it. You need to make sure when you're looking at companies, or you need to make sure that someone else who's looking at companies has checked out whether the company can pay back its short-term debts as they're likely to fall due. It's too easily overlooked by investors, and it is quite important. What do I mean? Well, current, quick and cash ratios are the answer. Now, for anyone thinking, oh crikey, where's he going now? I'm going to take a very quick look at one part of a balance sheet. Now, for people who've never seen a balance sheet before, do check out my Liquidity Explains video, what are balance sheets, okay, or balance sheet basics, and you'll get some more there, plus my balance sheet red flags video. So I'm going to take some knowledge for granted, but remember, companies have assets in the top half of their balance sheet, the funding is in the bottom half of the balance sheet, and the whole thing balances, hence the expression balance sheets. The top and bottom come to the same number. The place where you can check out whether a company is able to meet its short-term obligations as they fall due is in here. Short-term current assets, short-term current liabilities, and the net working capital or net current assets position. And there are some very quick tests that you can do. So to take that on, imagine I zoom in to that part of the balance sheet and I see that a company has stock, that's stuff ready to be sold if you're a manufacturing business, receivables, that's amounts owed by other people, some cash sitting in the bank, those are current assets, good news, but we also need to meet some short-term obligations at the point the balance sheet's been drawn up. It's a bit like freezing your life now and looking at how much you are owed and how much you owe other people and trying to work out whether one will cover the other. Well, that's what we're aiming to do as someone looking at a company when we analyse net current assets. Now, you may not have to do this very often, but I want to give you a snapshot as to how important it is that someone does it or you do it. So, got some numbers here down the right-hand side. So we have total current assets of 330 million. We've got obligations to meet in the short term of 150 million. So our net working capital position, as it's sometimes called, is a positive 180 million. So just how liquid is this business? Well, what we can do is compare, just a quick snapshot, the level of all these current assets to that short-term obligation, short-term creditors balance, and get a multiple. And if you were to do that, add all of these up and divide, so take 330 and divide by 150, you get 2.2. So we're roughly twice covered. Not too bad. In other words, we've got twice the current assets, the good news, as current liabilities or bad news. But some people would say, hang on a minute, Tim, are you suggesting a company could liquidate stock in order to pay creditors? Surely not. Surely you're liquidating almost the family silver, the stuff you're supposed to be selling and trading to make profits out of. So we could take those out and look at something called the acid test or the quick ratio. Here, we'd be taking the stock balance out. This is a quick tour, taking those two numbers there and dividing by our short-term obligations. And that gives you a smaller level of cover, 1.5 to 1, but at least we've got cover. But then there are people who would say, are you really going to call up people who owe you money in the event of an emergency and ask them to what? Take a haircut on the amount they owe you, pay you less? Maybe not. Maybe the ultimate test of can you meet your short-term obligations as a business is cash cover. To what extent does that cover that? And in this case, we've got a ratio 110 over 150 of 0.7 to 1. Okay? In other words, our cash balance isn't sufficient to cover the amount that we owe creditors in the short term if they were ordering up and ask us to pay them back. And creditors include things like the amount we owe to trade suppliers, the tax man, interest on debt, and so on. So there you have it. Most people watching this video won't ever have to do this, but these are vital numbers to assess whether or not a firm is able to meet its obligations as they fall due. So there you have it, a very quick tour of liquidity from a personal point of view and liquidity from a corporate point of view. In part 2, I'll look at the investment side of the equation.